A bank doesn't lose sleep over people who are broke. Broke people can't be billed. What actually keeps a retail bank's lights on is someone who's almost fine, just short enough, just often enough to need the product one more month. There's a number where that stops working on you. It's not the number your financial planner talks about. It's the number your bank quietly hopes you never reach. I'm going to give you that number, show you the 5 ways institutions are built to profit from you before you hit it, and then show you dollar for dollar what happens the moment someone crosses it, including what it does to your salary negotiation, your car insurance, and a conversation with your landlord that has nothing to do with banking at all. Picture a subscription you never chose. Not one line item, a whole invisible layer sitting under your bank balance, quietly deciding what you pay for a car loan, whether your card carries a balance, whether your account dips low enough this month to trigger a fee timed to land exactly when you can least afford it. None of it is illegal. All of it is engineered. And it's aimed with real precision at a specific savings range, roughly under $20,000 in accessible cash. Below that line, you are, in the internal language of account profitability models, a high-value customer not because you have money, but because you don't have quite enough to leave. Here's one piece of that machinery you can actually see if you look. When several charges hit your account on the same day, and there isn't enough to cover all of them, the bank decides the order they get processed in, and that order isn't random. Some institutions have historically run the largest charge through first, which knocks a string of smaller purchases into overdraft instead of just the one. Run the small charges first, and maybe one thing bounces. Run the big one first, and 4 things bounce instead of 1. Same math, 4 times the fee. Nobody calls that a bug. It's a setting. A friend of mine, I'll call him Henry, managed a regional credit union for over a decade. He once told me the internal reports never ranked customers by balance size. They ranked them by engagement, a polite word for how often someone triggered a fee. The customers with real money barely showed up on the report at all. They'd moved to private wealth management years earlier and touched a checking account maybe twice a month. The customers driving quarterly numbers were people earning solid, ordinary incomes, carrying a little revolving debt, occasionally dipping negative, reliable, recurring, and, in the report's own language, sticky. Henry said the phrase that stuck with him for years. We weren't rooting for people to fail. We were rooting for them to stay exactly where they were. Henry told me something else, almost as an aside, that took me longer to understand than it should have. He said loan officers could often tell, within a few minutes of a conversation, whether an applicant had somewhere else to go, and the rate they quoted moved accordingly, without ever being written down as a rule. 2 people with nearly identical credit scores could walk out with different numbers, not because one was a better borrower on paper, but because one of them sounded like they needed the money today. Nobody trains a loan officer to do this deliberately. The market just quietly rewards it when they do. Here's the part almost nobody explains. Money stress doesn't just cost you fees, it costs you cognition. Researchers who've studied financial scarcity have found that people under acute money pressure perform measurably worse on reasoning tasks, not because they're less capable, but because a portion of their mental bandwidth is permanently occupied running the background math of, will this bounce? That's why financially stressed people are more likely to take the first offer, more likely to fall for limited time pressure, more likely to skip comparison shopping they'd normally do without thinking. It isn't a character flaw. It's an engineering fact about the human brain under load, and it's a fact the businesses pricing your next loan or subscription are quietly aware of, whether or not they ever say so out loud. Think of it less like a wall and more like a tide line. Below it, everything in your financial life is being pulled by a current you don't control. Overdraft timing. Interest rates nudged a point or 2 higher because a lender senses you can't walk away. Insurance premiums priced against your risk of missing a payment. Above the tide line, the same current simply stops reaching you. Not because you got smarter or luckier. Because the businesses on the other side of every transaction can tell, often within seconds, whether you have anywhere else to go. The tide line, for most median income households, sits close to 3 to 4 months of core living expenses in real, accessible savings for a lot of people that lands near $20,000. Above it, lenders quote you differently. Insurers price you differently. Even your manager, in a way that's never written down anywhere, treats you differently. I want to tell you about someone I'll call Linda. She spent 6 years at a company where her manager routinely took credit for her work in front of leadership and just as routinely reminded the team how replaceable everyone was. Linda knew exactly what was happening. She also had about $1,800 in savings, a car payment, and a younger sibling she was helping support. Knowing something is happening and being able to act on it are two different skills, and the second one runs entirely on cash. It took Linda 2 years of the same automatic transfer discipline we just talked about to build real savings. She didn't get a raise in that window. She didn't get a better manager. What changed was that one Tuesday, she interviewed for a role at a competitor, got the offer, and put in her notice the same week, calmly, without asking permission from her bank account first. Her old manager offered to match the new salary on her way out. She said no, not out of spite, because for the first time in 6 years, she actually could 3 things. Starting this week. First, total your actual leak. Pull 12 months of statements and add up every overdraft charge, every maintenance fee, every dollar of pure interest you paid on a balance you didn't choose to carry. For most households under the tide line, that number lands between $1,000 and $3,000 a year, money that bought you nothing. Second, open your savings somewhere your checking account isn't. A different app, a different login, a 2 to 3 day transfer delay is a feature, not an inconvenience. It's friction between a hard day and an impulsive tap. Third, automate a transfer for the day your paycheck lands, before you've had a chance to mentally spend it. Treat the number that's left in checking as the only number that exists. Take someone earning around $70,000 a year. Take home pay a little over $4,000 a month. Expenses, eating most of it, a stubborn few thousand in savings that never seems to grow because every few months something eats it. The fix isn't a raise. It's separating spend from protect into 2 different accounts with 2 different logins and letting one small automatic transfer do the discipline a willpower-based plan never manages to do consistently. A year of that, even with a real emergency, landing somewhere in the middle is often enough to cross the tide line. And the moment it happens, the changes aren't emotional, they're structural. Credit utilization drops because the credit card stops functioning as an emergency fund. A credit score climbs enough to requalify for a better loan rate. An insurance deductible becomes safely raisable because there's now real cash behind it. None of that required more income. It required the order money moved in. The most common mistake isn't overspending. It's keeping all your money in one place. One login, one tap away from itself, so that saving and spending are functionally the same account wearing 2 labels. The second mistake is treating a credit card balance as normal background noise, instead of naming it what it actually is, an emergency fund you're renting at 20+% interest. The third is assuming the fix requires a bigger income before it can start when the actual leverage point is sequencing, not salary. People assume this is a math problem that only resolves once you're earning more. It mostly isn't. 2 households earning the same income build savings at wildly different speeds, depending on nothing more exotic than where the money physically sits and how many steps stand between a bad day and a withdrawal. The income determines how fast you could move. The structure determines whether you actually do. The system isn't rigged against your income bracket. It's rigged against the absence of a cushion. And cushions are buildable regardless of what you earn. Below the tide line, the current sets the terms. Above it, you do. Nothing about crossing this line requires a talent for investing, a lucky trade, or a platform promising to double your money by next quarter. It requires one automatic transfer that runs whether or not you feel motivated that week, repeated for long enough that the number in a separate account quietly stops being fragile. That's the whole mechanism. It was never supposed to be complicated. It was only ever supposed to be consistent. If you want to know roughly where your own tide line sits, drop your monthly core expenses in the comments and I'll help you ballpark it. And if this kind of thing is useful to you, subscribing is genuinely the only way this channel's videos reliably reach you. Again, the algorithm just isn't built to do it otherwise. See you in the next one.